Good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and we have spent the last roughly 4 weeks or so, 3 weeks or so, exploring options selling for income. And we started out at the longer end of the curve with monthly options, then we moved on to weekly options, and last week we covered the very short end of the term structure, which are 0 days to expiration. And based on the overwhelming feedback, based on the overwhelming amount of viewers from all over the world that attended last week's session, we've decided to extend some of the topics from last week, including some of the feedback that we got, and incorporate it into this session where we will talk a little bit about the products that you can trade with regards to 0 days to expiration, what are the differences in those products, and one piece that you guys have told us that you were really looking for, which was technical analysis. Last week, I talked a little bit about the different market internal indicators that are required to trade 0 days to expiration to give you a better sense for direction when you're trading intraday. So we're going to go over some of that here today before we open this up for Q&A. But if you're new to OptionsPlay here, I do want to remind you that we are here every single Thursday afternoon dedicated to help you become a more sustainable and confident trader. These sessions are designed to make sure that you have access to the right education to help you become a well-rounded and knowledgeable trader where you feel that you have the ability to confidently grow your account in the long run. And as you can see from the chats, there are many of you here joining in, chiming in, saying hello from just about anywhere around the world. And if you're joining us for the first time, feel free to chime in and tell us a little bit about yourself and where you are joining from today. But before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we will be using as example purposes during today's session. So what we're going to start off with today is looking at the difference between ETF versus index options, specifically for 0 days to expiration. We're going to talk a little bit about the differences between the products and what advantages and disadvantages each of the products will have to help you decide which is the right products for your portfolio. Then we'll break down amongst effectively what are the two different types of or the two symbols that you can potentially trade, which is the NASDAQ 100 and the S&P 500. We want to talk about within each complex, what are the different products that are listed, what are the symbols, and how you can access each one and what the differences are along NASDAQ 100 and S&P 500 trading products. Then I'll dive into the trading strategy itself, meaning the strategy that you want to deploy when you're trading intraday. When you're trading 0 days to expiration and you have to effectively make a judgment call between the open and the close and where the markets will likely end up, what type of market internals you want to take a look at, and then we'll do a deep dive across 4 of the most popular market internal indicators that I use to help me better understand who is control of the markets for that day. And then at the very end, we'll open this up for Q&A. But the primary thing that I want you to be able to walk away from today's session is a clear understanding as to what is the foundational knowledge that you need in order to start trading 0 days to expiration options. And we'll talk about the different products that I can trade 0 days to expiration and what are the differences and how can I determine an intraday market direction for trading 0 days to expiration. Those are the two primary breakdowns that's going to help us accomplish our goal of building that foundational knowledge, building on top of what we learned last week to really give you the knowledge to start trading these types of strategies with 0 days to expiration if these are new to you. And a common question that I get from these sessions is, can I get access to the recording? Can I get access to the slides? And can you get access to the platform that I will be using during today's session? And you can do all of that by pointing your phone to that QR code or signing up at optionsplay.com/sign up. And we will post a link into the chat window so that you can follow along. We post these recordings every single Sunday on YouTube. You'll be able to get access to those recordings and the slides. But more importantly, you'll be able to get access to the platform to allow you to trade these types of strategies and analyze these types of strategies in your portfolio. So let's kick off. Let's take a look at the differences between ETF and index options. And really, when it comes down to the difference between the two types of products, they are effectively tracking the same index, but the biggest difference comes down to the fact that ETF and stock options are for physical delivery and index options are for cash settlement. What that means is that at expiration, if you are a buyer and you are in the money, those will automatically be exercised, and you will either have to take delivery or short sell 100 shares of the underlying stock or ETF at expiration if you're in the money. And if you're on the other side of the trade, meaning if you're an option seller and it's in the money, then you will also be assigned whether you're long or short 100 shares at expiration, depending whether you're call or put. Now, for most traders that are trading 0 days to expiration, this is expiration obviously happens every single day. This could be a bit of a headache of managing trades ahead of expiration, meaning if you're in the money, you basically have to make sure that you close out your trade prior to 4 p.m. Otherwise, you will have exercise and assignment risk. Something that many traders that are trading 0 days to expiration options do not want. And this is really where index options comes in, because whatever gains and losses you have on the call or put that you're trading, whether it's in the money or out of the money, those options will be settled in cash, or rather it's only in the money options that will be settled in cash. But whatever differences that you have in P&L, you will never have to deal with physical delivery. Whatever your P&L is, that's just going to be debited or credited out of your trading account at the end of the day. So it's a much cleaner way to trade, and you effectively avoid all exercise and assignment risk. And that's the biggest benefit to trading index options. The downside, really, there's really, in my opinion, only one downside to index options, which is their size. Most of index options are very, very large, and we'll take a look at that. S&P 500 is a $500,000 contract. NASDAQ 100 is a $1.8 million contract. Now, the exchanges that list these products have been trying to address this problem. The fact that most retail traders cannot access that type of size by listing smaller notional value index options. But the problem is that a lot of them are not very liquid, or certainly not as liquid as the SPX or NDX. And we'll take a look at that here in 1 second. But sizing of these products is really kind of the biggest drawback, in my opinion, for index options, especially if you're a retail trader trading with an account under $50,000, $25,000. These index options are largely inaccessible for those types of portfolios. ETF and index, ETF and equity options are all PM settled, so it's really easy to manage them because they all expire on the last print of that expiration date. Monthly index options, most of them are PM settled, meaning what you're used to with stock or ETF options, but some of them are AM settled, meaning they're settled based on the opening price of the day as opposed to the closing price of the day. It adds a little bit of complexity because the last trade is actually the previous day, and you basically hold on to a position overnight, and based on the first opening print, that determines the settlement of your options. Not something most people want to be doing with their options. It's pretty easy to avoid, but that is one thing to be aware of. And then the last thing is taxes. If you're trading in a taxable account, ETF and stock options are taxed at ordinary income. Index options have a preferential tax treatment, 60% long-term capital gains, 40% short-term, which means that your highest effective tax rate is lower when you're trading index options versus trading ETF or stock options. So something to just be considerate of with regard to thinking about which one of these products you might want to trade 0 days to expiration with. So let's take a look at the S&P 500 complex. Obviously, the most widely tracked and traded index option group, if you want to call it that. The most liquid and the most widely traded product is SPX. Many of you know it as SPXW because SPX is really kind of the AM settled monthly contracts versus every other one that most people trade. The dailies and the weeklies is SPXW. That's really where the index options expire on the last print of the expiration date or the closing price of the expiration date. S&P obviously right now is around a $5,000 index value, and with a $100 multiplier, that makes it a $500,000 contract, a little over $500,000 contract. These are AM and PM settled. This is kind of the gold standard when we talk about index options in terms of liquidity, in terms of access to the number of expiration dates that are available. But both SPX and XSP, which was something built to kind of to deal with the size of SPX, both of these are fairly liquid and offer the same benefits. XSP is simply 1/10 the size of SPX, so it's still a $100 multiplier on the contract, but it's a $500 value index. So it tracks the S&P 500 just exactly 1/10 the value. So on a 100 multiplier, you basically get the same benefits of SPX, but at a size that's 1/10 the price. And because this is a product that was predominantly built for retail traders, they only offer PM settlements, which is a nice benefit from that perspective. You don't have any options that are AM settled. Now, both of these products offer a global overnight trading hours. This is the only listed option in the world, in the United States, that offer overnight trading. Meaning you can trade it from, I believe, 8:15 to 9:15, 8:15 p.m. to 9:15 a.m. the next day. So you have a full 13 hours of overnight trading in SPX index options, something that no other products offer you with regards to trading. So if you like to trade overnight, you know, a lot of action does tend to happen overnight. Just keep in mind that the overnight trading is not nearly as liquid as the daily sessions, but it is something that you should be aware of, that you can trade these overnight. Not every broker supports that, but they are available for trading overnight at the brokers that do support that. And there was recently an introduction of nanos, which is meant to be even smaller than XSP. This is meant to be 1/100th of XSP. So XSP on a $500 index value with a 100 multiplier means it's a $50,000 contract. Nanos is literally a $500 contract. These are similar to XSP, made for retail traders, so they're all PM settled. There are very, very few expirations available for the nanos. The symbol for it is NANOS. I think if you look at today, there might be only 4 or 5 expirations that are available. They were kind of built just for the dailies. So you're kind of trading only first, ones that are expiring today, ones that are expiring tomorrow, and then there's a couple of other contracts listed, but they're really not made for anything other than trading 0 days to expiration on a very, very small size. They have a $1 multiplier on effectively what is the same index that tracks XSP. And then lastly, you always have SPY. This is the gold standard when it comes to the ETF option that tracks the S&P 500, because SPY is currently around $100. Each contract is for 100 shares. from a size perspective, SPY and XSP are very similar. Now, SPY is far more liquid than XSP. So, the ETF in this particular case, from a liquidity perspective, is very similar to SPX. So you kind of have the gold standard with regards to liquidity, trading these types of products at the size of these types of products. So there's a lot of things that you have to consider here to determine what's the right trade for you, what's the right product that you might want to trade index options with, based on liquidity, based on size, based on what matters to you with regards to the hours that are available for trading. But from my perspective at the moment, nanos as a product just simply isn't quite liquid enough, in my opinion, for most trading of these types of products. These are newly listed products. There's not a lot of volume in them right now. So that's something to be aware of when you're trading S&P 500 index options. Next, I'll look at the NASDAQ 100, which is the second probably most popular product for trading these types of daily options. Most of you are familiar with the NASDAQ 100 index, which is the simple NDX that has an $18,000 index value, which means that a $100 multiplier is a $1.8 million contract. These are the biggest in terms of size, but also the most liquid. Trades, tens of billions of dollars in notional volume a day, so plenty of liquidity. To address the problem with the size, there is NQX and there's XND, 1/5 and 1/100th the value of NDX. Both of these products similar to XSP and the nanos. Basically, the further in size you go down, the less liquid they are. So one is a $360,000 product and one is an $18,000 product. So contract sizes that are better suited for retail trader, all PM settled, so you really don't have to worry about exercise and assignment risk. And all three products, the NDX, NQX, and XND, offer extended trading, but not overnight trading. So you can trade it from 9:30 to 4:15. You basically get an extra 15 minutes to trade these products versus the S&P. You do have true overnight trading for about those 13 hours overnight before the market opens in the morning. So for a lot of traders, in my opinion, when you're trading the NASDAQ 100 index, right? You really have a product that's either you have a very large account and you can trade NDX, or you might want to take a look at some of the products like just an ETF options like the Qs, because the Qs is very deep in terms of liquidity that match similar to NDX, but obviously at a size that's far more favorable for retail traders, a $44,000 contract. Because the ETF is currently around 440, multiply that by 100 shares, that's a $44,000 contract versus the 1.8 million on NDX. The only obviously difference is that you have physical delivery, which means that you have to manage expirations a lot closer than you do with index options. So this is something that you have to be aware of with regards to trading. A couple of questions with regards to bid-ask spreads. Bid-ask spreads is not always a great indication of liquidity. The NASDAQ 100 is one of the most widely traded contracts in the world. We are talking about tens of billions of dollars traded in terms of volume each day. I think for most traders here, especially as a retail trader, liquidity is never a problem when something that trades tens of billions of dollars a day. I'm sorry, but you're just never going to run into a liquidity problem on something like that. Unless you're an institution trying to execute an order for tens of millions or hundreds of millions of dollars a day, you're just not going to run into a liquidity problem with any of these two products that we refer to. So now that we've talked a little bit about the product and the different products that you can trade, and it's going to take a little bit of time to digest and try out the different products to see, what works for you from a settlement perspective, from a sizing perspective. But the S&P and the NASDAQ 100 are two products that are, have about a 95% correlation between the two products. And that's over 10 years. They have different volatilities. NASDAQ 100 is obviously more volatile than the S&P 500, but they are very, very highly correlated. So when it comes to trading the two products, the strategy is quite similar to each other. And it comes down to something that we discussed last week, which is the fact that most trading days lack strong direction. Only about 15 to 20% of all days have what we consider a strong directional tilt that's suited for buying. Most days, about close to 80% of the days, is better suited for option selling. And we covered the option strategies last week. We covered which strategies are suitable for option selling, which strategies are suitable for days where you do see that big move. But largely when we talk about trading strategy and indicators for trading 0 days to expiration, there's really one primary thing that we're trying to determine, and that's who is control, buyers or sellers, who is in control. Price action alongside the breadth indicators will provide us with the most complete picture of who is in control. And that is what we're trying to determine in the morning, preferably in that first hour or so, using these indicators to get a sense for, does anyone have control? And if not, look at option selling strategies. And if buyers have control or sellers have control, look at potentially trading a directional strategy. And what you're trying to do is determine in that first hour, does anyone have control? And throughout the day, does that team, if you will, maintain control? When you have one side of the market have control in the first hour and then maintain control through the close, doesn't happen very often, but when it does, that's when you get those 2-3 standard deviation moves in a single day. And that's really when you buy that out of the money option that turns, $100 investment into a $500 gain at the end of the day. It doesn't happen very often, but when it does, what you very clearly see throughout the entire day is that from the very open, someone has control and they effectively maintain control the rest of the day. It doesn't happen very often. Most of the time, you kind of have traders, one side of the market maintain control, and then by the first hour or so, that fizzles out, or you get some control and it comes right back. So what we want to do is we want to use different market internal indicators to help us understand who is in control. So I'm going to go over 4 of the most popular market breadth indicators or market internal indicators in order to help me understand whether or not if one side of the market is maintaining control. So first and foremost is what we call volume profile. This was invented by the CME and the Chicago Mercantile Exchange back in the 70s or 80s. There's actually a CME handbook that was written in the 70s or 80s on volume profile. It's a very, it's a bit of a dry read, but it is considered the Bible on options, on volume profile. And volume profile is simply plotting volume instead of here at the bottom of your chart across based on time, meaning how much volume was traded at a specific time. What you're looking at is how much volume was traded at a specific price. And you basically have these little bars, and it tells you at a specific price how much volume was traded. And when you look at volume profile, you typically reset it on each trading session. So each trading day, you reset, the volume that was traded at that specific price. You can look at volume profile across the days, meaning you can look at volume profile across all 4 or 5 days that I have on my screen. But predominantly what you're looking at is volume profile on a single trading session. And what you're trying to do is at least for the purposes of this, right? Volume profile, there's multiple uses for it, but at least for the purpose of this, what you're looking for is the shape of the profile. You're looking for profiles that have a bit of they exhibit 2 types of shapes. They either exhibit kind of a bell-shaped type shape like we have here in the first 2 trading sessions, where the profile is kind of evenly distributed across what we call a point of control, or kind of a price at which, there seems to be a somewhat equal amount of volume traded below that price and equal amount of volume traded above that price. And it's kind of distributed what looks like a bit like a bell curve, or at least a bell curve on its side. And what that tells you is that there's a bit of equilibrium in terms of market buyers versus sellers, and they're kind of oscillating between across one point, and it gives you that kind of bell curve like shape. And you really see that within the first hour or so, is this kind of shape starting to play out. And then on the other side, you also have shapes that are more flat. Like as you can see here, this is a much more flatter profile as opposed to the bell curve shape profile. And when you see that in the first hour, and actually when you look at this particular, when you look at this particular chart here, this is really the first hour, right? And you can see that the bar, the volume profile within that first hour, it doesn't form that bell-shaped curve. It kind of is just a flat profile. And what that gives you a good sense for is that, okay, it looks like one side of the market is maintaining control and either pushing the markets higher or lower. And simply price action will give you a sense for whether it's buyers that have control or sellers that have control for that day. And the way you think about volume profile is that if you start to see this bell curve shaped reading in that first hour, that kind of gives you a good sense that at least for the first hour, there isn't a strong side that has control. You have that bit of that equilibrium. Those are opportunities to be an option seller for that day, versus when you have a flat reading and you can clearly see control by one side, those are opportunities to potentially be a buyer of options on those days. Now, this happens to be the sessions from yesterday and the previous day. And as you can see in the first hour or so, you do maintain. Yesterday was actually a bit of an interesting day, because for the most part of the day, for probably until about 2 p.m. or so, you did have that bell curve, bell-shaped curve. It was only at about 2 p.m. or so, and we'll take a look at some of the other indicators today, where you saw all of a sudden one side of the market maintain very strong control. So, this is something that does change throughout the day. This is not like you can just look at the first hour and set it or forget it. This is one of the things about day trading, or one of the things about trading 0 days to expiration, is that you kind of have to be in front of your screen all day. So if you find yourself, hey, I don't have the time to sit in front of my computer from 9:30 to 4, just keep in mind that 0 days to expiration strategies may not be suited for you, because these are things that do change. Sometimes they change on the dime, and sometimes they change very late in the day. Yesterday from 9:30 to 2 p.m., very bell-shaped curve profile. You really kind of had a good sense that there was a very good sense of equilibrium, and something at 2 p.m. just shifted. And you can see it from the other indicators that I'll show you here today, but also on the volume profile. You started to see it around 2 p.m. The profile started getting really flat, and by 2:15, it was much flatter than that. And you start to see this huge upside volume. And when you see it in conjunction with the other indicators that I'll show you here today, that's really when you can start to see, okay, something happened around 2 p.m. where clearly some type of institutional buying came in, and it was incredibly strong into the close. And that is, for those of you that were nimble enough, potentially time to get out of your option selling, and maybe, even though there's not much time, looking at buying an option that could have been quite fruitful yesterday. The day before, you had the profile that was pretty flat by about 10:30, 11 o'clock. Clearly showing buyers were in control. And then by 2 p.m., 1:30 or so, you started to see more of a bell-shaped curve develop again, which was giving you a good sense that perhaps that momentum was gone. And when we look at the other indicators as well, that was also showing you some of that momentum here that kind of carried in the middle, started to die down towards the end of the day. So, but the volume profile is dynamic, it changes, but it's the shape that gives you a good sense for whether any side of the market, buyers or sellers, have control. Does that make sense to everyone? Please type 1 into the chat window if that makes sense to you. If you want to learn more about volume profile, in my opinion, is an incredibly powerful tool, not just for day traders, but for longer term traders as well. Looking at, from my perspective, volume based on time means almost nothing, because time is sort of a very arbitrary thing that we've invented. Volume based on price is far more valuable. You can look at it on a longer term chart. It's something that you can use it on OptionsPlay as well. Our charting package allows you to create volume profile charts They're useful for longer term trading, looking at kind of where there are peaks in terms of the volume profile, where there are troughs in terms of volume profile, gives you insight into support and resistance for longer term trading. So this is really something that you should be aware of. And there's a handbook written by the CME that's considered the Bible of volume profile that I do recommend. It's a dry read. It's a couple of hundred pages, but it is considered the Bible on volume profile. You can obviously try other educational sources on volume profile, but that CME handbook is considered the Bible. The second thing that we want to take a look at in conjunction with what we were talking about is what we call cumulative tick. This is published by the New York Stock Exchange. Most brokers platforms have access to it. The symbol is just tick, $ tick, depending on the platforms that you're on. Usually it's usually $ tick. And all it tells you is at the very moment, this indicator, which is this one here at the bottom, is an extremely noisy indicator that I actually don't recommend most traders to look at the indicator itself. What we want to look at is a modification of that indicator. But what it tells you is that at that very moment, how many stocks are ticking higher and how many stocks are ticking lower. It's basically subtracting the number of stocks that are ticking higher versus the number of stocks that are ticking lower at that very moment. And it's very chaotic and it's very noisy in terms of an indicator. And many times when you're just looking at it, you might find that it's actually not very useful. So another way to read it is the cumulative total, which I find is much easier to read. That's what we have here on the bottom. What we're doing is basically after each 15-minute bar, or in this particular case, this is and this 15-minute bar, you take the closing value of that cumulative tick, and within each session, you just add it up. So if you have more stocks that are ticking higher in this 15-minute session or 15-minute candle, you kind of take the value of that and you take the next 15 minutes. If it's more stocks are ticking higher, you add to it. If now, for example, there are more stocks that are ticking lower, you subtract from it. And what you're really looking at is how it progresses throughout the day. And usually these types of cumulative tick candles that reset every single day, what you have is basically color coding that gives you a sense for whether there's an increasing or decreasing tick that's consecutive, or it starts to break down, right? So as you can see, if you get consecutive red bars, that tells you that the tick continues to maintain negative and it's getting more negative. If it's green and you have consecutive green bars, that's increasing and consecutively continuing to increase. And then when you start to see these dark bars, that means that even though it's still positive, it's decreasing, right? So what you're really looking for are continuous bars of either increasing or continuous bars that are decreasing without a break in trend. And that's really what's showing you whether buyers or sellers have control. So when you have this kind of continuous bars of increasing, like you saw yesterday from about 2 p.m. on, basically for roughly 3 hours or so, it was very cumulative in terms of there was no let up in terms of buying. There was one 15-minute bar that had a slight decrease and it went straight back up. And that really told you that. And notice how this started moving higher here well before the actual big move here yesterday. You know, we basically saw some buyers step in near the lows of yesterday, and those buyers were extremely strong and really pushed the markets higher in the last 45 minutes of trading. But that's really kind of what you're looking for. And most days you don't really get it. You know, most days, as you can see, you kind of get a little bit of buying and it kind of dies down. This was a pretty strong day that kind of tapered off a little bit at the end of the day. But as you can see from that trading session, that was a pretty strong day where buyers maintain control throughout the day. It's not perfect, right? Sometimes you get big moves here to the upside where that cumulative didn't look particularly impressive, but if you did look at the tick itself, you did see some really high ticks, meaning what we're seeing is some 15-minute periods where there was an extreme number of stocks that were ticking higher versus stocks that were ticking lower. And then you also have this day, this day where, it seems like pretty much sellers maintain control all day. And that's really kind of where you saw, if you look at the session here, clearly downtrending day on the session. So this bottom section is really just taking this cumulative tick data that's coming from the exchanges um, and, and honestly, I don't know why they call the indicator cumulative tick. It's really just tick. What this here at the bottom is what we call cumulative tick. We're basically taking the values and continuing to add them up throughout the day. So if you have a number of stocks that are ticking higher in this 15-minute period, you add to it. If let's say also in the next 15 minutes there are more stocks that are down than up, then you subtract from it, and that's how you get this cumulative tick number bar here at the bottom. And that resets every single day. You start from 0 at the beginning of every single day. So you kind of start from 0 and you kind of get a reading from the first hour or so. That's, if you're looking at 15-minute bars, that's 4 data points. And what you're seeing is over those 4 data points, is it continuously trending in one direction or another, or is it just oscillating higher or lower? When you do get those continuous bars of increasing or decreasing values, that's when you see that buyers or sellers have control. Those are your opportunities to be buying options. And then when you see them kind of oscillate around a specific value, like some of these days that I'm showing you here, those are kind of more option, days where you want to be as an option seller. And the red or green bar just gives you a sense for whether buyers or sellers have a bit more control on that given day. If that makes sense, everyone, please type 2 into the chat window if that makes sense to you. Symbol for that is typically $tick. This is an indicator published by the New York Stock Exchange. So most brokers platforms will have access to it. You can obviously look at it on TradingView as well. But this is the most chaotic of indicators, but this is also one that will turn the fastest. Meaning when you see buyers step in, you will see it show up on cumulative tick immediately. This is kind of a leading indicator. It gives you a real-time sense for whether buyers or sellers are maintaining control and whether they're maintaining that control throughout the day. Another very popular, probably the most popular market breadth indicator is what we call advanced decline. And this is simply just subtracting the number of declining stocks in the NYSE from the number of advancing stocks on the NYSE. And the difference between tick and advanced decline is that advanced decline measures whether a stock is up or down from the start of the day, versus the tick is literally what the current tick is, right? So it's kind of very chaotic. What was the last tick? Did the stock tick higher in the last tick, or did it tick lower in the last tick? Versus advanced is saying, how's this, how many stocks are up on the day versus how many stocks are down on the day, and we're subtracting one from the other. So advanced decline, even though similarly to tick, is measuring kind of the same thing, but we're looking at a different time frame, so it's less chaotic. You're looking at kind of how many stocks are up on the day versus stocks that are down on the day. And you want to use it in conjunction with volume and price action to give you a better sense for kind of the strength of it. But basically what you're looking at is readings that are above or below 1,000, or above 1,000 or below -1,000. Because when you have days like yesterday, right? Days like yesterday, we basically opened the day at about 1,600 advancing stocks. If you take out all the advancing stocks and minus all the declining stocks, you had 1,600 positive advancing stock for the day. That's an extremely positive reading, telling me that buyers seemingly have control for the day. And what you really want to see is that buyers have control in the morning and maintain that control. So as you can see, the lowest that we ever got to yesterday was only about 1,300. That's the low of the day, right? That gave you really good sense that buyers had control, and notice how the increase in value going into the close, meaning not only did buyers have control, they were actually increasing their kind of control throughout the day. And that was a big way to end the day. And then you also have days where, you open up around 1,000 advancing stocks, but throughout the day, very quickly, it kind of starts to deteriorate, right? That was yesterday, right? So we opened up, we gap higher here, and then we started to deteriorate immediately. And that gives you a good sense that buyers maybe started the day with a little bit of control, but quickly lost it. You also have days like this where buyers started off negative. We were negative 400 in terms of starting out the day, 500. And then very quickly within the first hour, we saw that buyers started maintaining some control. By lunchtime, lost it. And then all of a sudden, you see that big move here. And notice that big move in terms of buyers maintaining control gave us a good sense that, there was going to be a rally into the close. And then most days you really get not a whole lot, right? Like days like this where you kind of start out around 400 and it oscillates between 400 and negative 200. This is just basically staying within its range. Not much is happening. And, sometimes you kind of get a start around zero, it kind of pushes a little bit higher in the afternoon, but it pushes into 1,000, but it kind of weakens a little bit. That just gives you a sense that no one really has control. Versus some days where you kind of open around negative 400, it pushes down to negative 1,600 immediately and it stays there the whole day. That tells you sellers have control over that day. So what you're really looking for are readings that open and remain above either positive 1,000 or negative 1,000. That gives you a sense that there's control or a strong shift from positive to negative. Those are your potential opportunities to be an option buyer for the day. Readings that oscillate between negative 1,000 and positive 1,000 show a lack of control by either side, and those are your days that you might want to be selling options. So the advanced decline ticker symbol for that is ADD, typically $ADD, advanced decline. Something, again, also published by the New York Stock Exchange. So most brokers platform have this indicator as an intraday value. It is something that should be done when you're looking at it. It should be reset every single day. There's also a cumulative advanced decline where basically you take the values of each day and you keep adding to it and you kind of get this continuous advanced decline line. That's not what you're looking for. You're looking for the intraday version, which resets every single day. And lastly, which is volume ratios. So all the other ones that we talked up until now were price-based indicators. The other one you want to take a look at is volume-based indicators. And this is basically very similar to advanced decline, but instead of looking at the number of advancing stocks versus the number of declining stocks, you're looking at the volume of advancing stocks versus the volume of declining stocks. And you're taking the ratio of that. And that gives you a good sense for whether, when you get a strong advance, whether there's any volume behind it. And readings that basically stay consistent for what you're really looking for are readings where it's consistent for at least the first hour of the trading day or into the close. So this is the indicator here at the bottom, right? It kind of oscillates around the one is kind of the equilibrium, right? If kind of the number of volume of advancing stocks is equal to the volume of declining stocks, you get a reading of 0. Anything above 0 tells you that stock buying is at a higher volume than stock selling, and vice versa. Stocks below 1 tells you that selling is at a higher volume than buyers, right? So 1 is kind of your equilibrium, and what you're really looking for are either readings above 3, which tells you that clearly there's a strong that buyers are maintaining not only control, but there's a lot of volume behind it, or negative, 0.33, which is hard. And this scale is hard to read because, on the upside, you have infinity. On the downside, you're limited to 0. So it's a little bit harder to read. There are other ways that you can flip this. Some people look at the absolute value of this, but anything above 3 tells you that's a strong buying. Anything below 0.33 is strong selling. So when you get that reading, and really, as you can see, you have days here, right here, where it was giving you a sense that, there was strong selling. This was another day that there was potentially strong selling. And then, as you can see, there really aren't many days where you're above 3, right? So on this day, you opened up above 3, it kind of pushed really high, but quickly by 10:30, 11 p.m., that died down and we quickly came back below 3. That gave me a sense that, that was basically because of this gap higher. You got that strong volume on the open that quickly faded, and that kind of didn't lead to going anywhere, right? Versus yesterday, we actually opened up around 2, which wasn't particularly strong in terms of buying, But then, as you can see throughout the day, it kind of continued to increase. And by the end of the day, we were well above 3. And that was kind of, and notice that before, when we pushed above 3, it was only around here. There was plenty of time to potentially get into a trade before it exploded to the very end. So readings between 0.5 and 2 are basically days that are lacking any strong control by one side or the other. That's when you want to be an option seller. Like I said, it's not very often that you get these readings that are above 3. Occasionally, what you get are days that open up above 3 and maintain above 3, and those are the days that happen. Those are your strong buying days. And if they open below 0.33 and they stay below 0.33, like this day, this is probably the only day here on your entire screen where you really got, these are 2 days where you got that. Where you kind of, even though in this particular case you didn't open below 0.33, you actually opened up around 1, but it quickly declined down to that 0.4, 0.3 level, and it kind of stayed there the whole day. That's really when we did get a sign that sellers were maintaining control for that day. So, these things by themselves are valuable, but they're not, in my opinion, by themselves that useful. You really have to look at conjunction of at least 2 or 3 of the indicators that I'm telling you here today, all aligning to the same thing to really justify to be a buyer of options for that given day. Otherwise, like I said, nearly 80% of the time, sometimes you can even get a really strong read in one of these indicators out of the 4, and the markets still just go nowhere for that day. Which is why you have to look at it in conjunction with each other. And generally speaking, about 80% of the time, you're going to find yourself in a position where no one is maintaining control for that day. And that just means that, looking at selling put credit spreads, looking at selling those double diagonals or the straddle straddle swap is really something worth looking for. Someone mentioned vol D, which is actually this exact ratio. It's the volume ratio of up-down volume. That is also something that you can look at as well. That's also a volume ratio as well. But hopefully this gives you a good sense for kind of the indicators that are useful and giving you a better sense for market breadth. Very different from the indicators that you're typically looking at, like moving averages, RSI, stochastics, those types of things, MACD. These are different indicators that are published by the exchanges. And it really gives you a good sense for what's moving the markets and, or rather, if the markets are moving and whether there's any volume behind that movement, because that's really what determines whether buyers or sellers are maintaining control. What you're really trying to get an understanding is there a large institution that's out there, working a large order and pushing the markets in one direction or another? There's no other way to really tell that intraday. Obviously, you can look at price action and seeing that happen, but many times when you look at these market internals, what you can see is actually a strong amount of buying or selling well before the market actually makes that move. Because when an institution's trying to fill a large order, it's not like it happens on the price movement. They could be filling an order for quite some time before that big explosive move happens. And only these market internals give you that type of information, but it's only useful within a trading day, right? Because these indicators all reset at the end of every single day. So you can't really use them for longer term trading, but you can certainly use them very much for day trading, which is something why we don't really talk about it here, because we're not day traders for the most part. So what you've learned today: index versus ETF products. What are the differences? What are the pros and cons? What are the different products that you can trade? We talked a little bit about the trading strategy. Understand who has control is really the primary thing that you're trying to determine every single day. And looking at whatever views that you have for the day, whether that's holding throughout the rest of the day or if that changes, it can change. And when it does change, you need to also shift your strategy. And then we looked at 4 of the most popular market internal indicators that provides us insights into who has control for that day and whether that is maintaining control or that is changing throughout the day. So I hope that hopefully gives you a better sense for how you might want to take a look at trading 0 days to expiration options and round out what we learned here last week, which is the option strategies, and today looking at some of the market indicators that help you determine direction for trading which one of those strategies for each given day. Like I said, just a reminder, most of the days you're going to be an option seller. Occasionally, you're going to find these days where you get strong volume and you clearly see buyers or sellers have control with volume behind it. Those are the days that you might want to pull the trigger on buying an option and turn, what could be $100 investment into a $400 investment by the end of that day. But that doesn't happen very often. These are the indicators that can potentially give you the insights to pull the trigger on those buying days. All right, so just a reminder, if you want access to the platform, if you want access to the slides, point your phone to the QR code, sign up for your free 30-day trial to OptionsPlay to access everything here. And what I'll do here is I'll open this up for Q&A. There's a Q&A window at the bottom of your screen next to the chat window. We'll open this up for Q&A for a few minutes, and I'll try to answer some questions before I sign off for today. Do you recommend the RUT or no? It's not that I don't recommend the RUT, which is the Russell 2000 index options. They're plenty liquid, just that the Russell doesn't move in comparison to the S&P and the NASDAQ, right? So I don't really see, an advantage to trading the Russell, and especially when you look at these market internal indicators, these are even though I think you can't get Russell 2000 market internals. You can get SPX internals, you can get NASDAQ 100 internals, you can get NYSE internals. You can't get Russell 2000 internals easily, in my opinion. So for those reasons, I think it's better to trade SPX and NDX because you can actually get the accumulation. You can actually get the advanced decline specific to S&P 500 stocks. I don't think you can get tick for S&P 500. So for those reasons, I prefer trading SPX and NDX, and they are also just slightly more liquid and they move more than Russell. Someone's asking if I can sell 1 day's expiration versus 0 days expiration before the market closed for the next day. Is there an overnight theta burn? Yeah, there is absolutely an overnight theta burn. One of the things about trading SPX is that you can trade the overnight session. But yeah, I mean, theta works even overnight. But the problem with trading overnight is that yes, you get theta burn, but you're forgetting the fact that you're exposed to the underlying movement. So that's the other thing you have to consider. And when you're trading 1 day to expiration options, your gamma is incredibly high. So even if XPF moves a little bit, whatever, you're going to lose. You could potentially gain, but you could lose all of what you gained in terms of theta overnight, orders of magnitude more than what you've gained in terms of theta, right? So if you sold something for $2.50, maybe it's worth $2 the next morning. That's only 50 cents. But if the market moves a couple of bucks, you've lost 4 or 5 times that, right? In terms of what you got, what you've received on the theta burn. So, the theta burn overnight is not enough of a reason, in my opinion, to hold that overnight. Are index options available on OptionsPlay? We currently only support the NDX complex of index options on OptionsPlay. Is NANO's cash settled? Yes, they are. I know you can exercise equity options early and you can't do that with index options, but what about submitting Contra Exercise instructions? I know this can be done with equity, but not sure about index options. All index options are cash settled. You don't have a choice. You don't do a contrary exercise assignment. They're all cash settled. You don't have to do anything at expiration for an index option. On a straddle swap, this is the more advanced strategy that we talked about last week. Why not widen the strangle to a 10 delta to reduce the overall cost? Because if you do a 10 delta, you're not getting much hedged exposure, right? So the 20 delta gives you a good blend of hedging the risk of the short straddle that you are short, the 0 days to expiration straddle that you're short. You want some hedges against that. If there is a big move on that day, your short straddle is going to lose money. You want to offset some of those losses with a strangle. And if your strangle is too far out, you're just not going to get much hedging, if you will. The 20 delta gives you a little bit more hedging. Would TQQQ be a good symbol for trading index options? First of all, TQQQ is not a index option, so you wouldn't be able to trade that. It is a triple leverage ETF option, which means the liquidity on those things are pretty poor, especially for options. And there are no daily options on TQQQ, which means that you can only trade them once a week. So that kind of makes it moot for this purpose. Was yesterday's action the result of end of month or end of quarter? Possibly. I don't think so because it wasn't the end of the month or the end of the quarter, but possibly. Ultimately, from my perspective, it doesn't really matter what the reason is, right? Or rather, why. You know, as technical analysts, we say that we're not in the business of why, we're in the business of what, right? What moved the markets, and we don't really care why it moved. We can all speculate as to why, and it's really just speculation. Is accumulation distribution of any use? Accumulation distribution is similar to advanced decline from that perspective and very much can be used. You know, I did use accumulation distribution quite a bit in my day trading years, but I do find advanced decline a bit more suitable for these purposes of trading 0 days to expiration. Last week you said exit the straddle at 25% of max gain. When do you re-enter the straddle? As soon as you take profits, you re-enter the straddle. You're basically locking in profits, and you're getting yourself right back in. And usually, what you're doing at that point is you might recenter your straddle, right? So if the market moves a little, you want to recenter and kind of constantly maintain a straddle that's at the current price of the stock or the ETF. For beginners unable to watch indicators throughout the day, is it better to sell weekly or monthly options? Yes. If you cannot sit in front of your computer all day, I do not believe you should be trading 0 days to expiration options. You should be selling weekly, perhaps monthly options for income. I think most traders have the time to look at their trading accounts once a week, right? So you can certainly look at weekly options. But if, let's say, you have even less time than that, monthly options may be more suitable. You know, someone's asking about trading iron condors on these 0 days to expiration positions. And, you know, one of the things that we talked about last week is that, you know, we talked about the put credit spread side. And the reason we didn't talk about the call credit spread side of 0 days to expiration is because call credit spreads for 0 days to expiration have a negative expected return because of the fact that markets drift higher 60% of the time. Which is why we typically don't trade iron condors on a 0 days to expiration, because the call side always underperforms. Now, what you could potentially do is say you want to skew the iron condor where you are centered instead of equally on both sides, you skew it to the upside, right? Basically, you're much closer to the put side and much further away from the call side. But what we even find then is that the call side is even more unprofitable because on the few days that the market moves significantly higher, you know, you basically lose significantly more on those trades because you have a call side on. And especially when the call side's further away, your risk to reward is very poor on the call side, which skews your risk to reward on the entire iron condor. So for those reasons, that's why we don't recommend selling a 0 days to expiration iron condors for any of these types of strategies. It simply will underperform for your strategy. That's correct. Dean, you do not want to use a single one of these market breadth indicators that we talked about here today. You should have at least two, if not three, aligning when you're thinking about buying an option. Otherwise, it's pretty clear across the indicators that kind of you don't really have one buyer or sellers maintaining control. Yes, there is a slide deck. We always send out the slide deck with the recordings, and they usually go up on Sundays. There is a specific advanced decline for NDX. You have to find what the ticker for that is at your broker, but yes, there are specific advanced decline numbers for NASDAQ 100 names. There are volume indicators for NASDAQ 100. There might even be a tick for just NASDAQ 100 names. So, those are one of the reasons why I also, think that for traders, stick to SPX and NDX, because you can actually find these market internals that are specific to the index that you're trading, versus what I showed you today was looking at the NYSE, which is a pretty good broad composite of the markets. But if you're trading, let's say NDX, and you just care about the advanced declines on those 100 names, you can even do Dow 30 advanced declines. That's also another one that a lot of traders like to use. Kind of a more narrow view of the markets, but usually gives you a good sense for whether buyers or sellers are maintaining control. When I say examples of how to read the combination of the indicators, with each indicator, I gave you thresholds, right? Thresholds that tell you if it's above or below this level, or if it's doing this, that tells you if buyers or sellers have maintained control. What you're really looking at is, are two of the indicators showing me that buyers have control? Are three of the indicators showing me that buyers have control? Or only one of them showing me that buyers have control, and the other ones are telling me that it's kind of more of an equilibrium, right? That's what I mean in terms of combination. So the more you have, or two or three of them are lining up and telling you clearly that, hey, buyers have control, those are your higher probability days to be buying options. Otherwise, you're better off selling options. If, let's say, only one of them is triggering, hey, buyers have control, the rest of them are not really giving you that same indication, those are probably not enough evidence to be a buyer of options on that day. So Matthew's asking a follow-up question to the straddle strangle swap. Would a 30-day 10 delta? Oh, I guess I've already asked that question. It's the same question. I think I've already answered there. What do you think of VWAP? VWAP is another one that I thought about adding in here, but I didn't add into it. VWAP is VWAP is more on the price action side of things. It'll give you it does give you some sense of whether buyers or sellers have control for the day, depending on whether price is above or below VWAP. But it's usually used more so as a support and resistance indicator a lot of times for traders to understand, on a pullback, when do you buy? If it breaks VWAP, that's a shift in kind of whether buyers or sellers have maintained control. And also the slope of VWAP also gives you a sense for how much volume is behind, buyers or sellers. But I do find VWAP as an indicator, it takes a lot more time to learn. It's an indicator that takes a lot more time to master. And I just didn't quite have enough time to dive into VWAP during today's session, but it is one other indicator that is commonly used by day traders to gauge, if buyers or sellers have control for a given day. So everything you said should be done with the caveat that we should only risk 1 to 2% of our total account value per trade. That is correct. Okay, with that is all the time that I have here for today. I hope that this is helpful in giving you a better understanding of 0 days to expiration options. Hopefully this helps round out your 0 days to expiration foundational knowledge with now, some information as to how you can measure market direction for a given day as to which one of the strategies that we discussed last week, when do you trade them. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.